A 33-year-old analyst published a blog post on Sunday night. By Monday afternoon, Uber had lost 6%, Mastercard had dropped 5%, and the S&P 500 was in free fall. Not from an earnings miss, not from a central bank decision, from a Substack post. Let that sink in. This is the AIA Uncut podcast.
It's been an absolutely surreal week to watch unfold.
It really has. Welcome to this deep dive where we are unpacking what has to be the most bizarre 24 hours in modern market history.
Right.
We're recording this on Thursday, February 26, 2026, and honestly, the dust hasn't even settled yet.
Not at all. I mean, usually when we sit down to analyze a market crash or a major correction, we have a stack of hard data in front of us.
Right.
We're looking at inflation prints, jobs reports, GDP numbers. But this week, we have a piece of speculative fiction.
That is the part that I just can't get over. The document that went absolutely viral this week, it's called the 2028 Global Intelligence Crisis by Citrini Research. And it is explicitly written as a scenario. It's written from the perspective of the future, looking back from June 2028. It is literally a thought exercise. And yet, it moved billions of dollars in real-time capital.
It did. And you know, to understand why, you really have to understand the mood of the market right now. Investors are so jumpy. They are looking at these massive AI valuations, and they're terrified that this whole AI bubble is actually a deflationary bust waiting to happen.
So they were primed for this.
Exactly. This report didn't just tell a scary story. It articulated the specific mechanics of how that bust happens. It gave a name and a face to the fear.
Well, today we're going to tear this report apart for you. We are going to look at the death spiral it predicts for software companies, why it argues Visa and Mastercard are basically obsolete, the massive crypto angle here, and this completely terrifying economic concept they call ghost GDP.
It's a lot to cover.
It is. But let's start with the catalyst. Who actually wrote this thing?
So Citrini Research is a pretty small boutique shop run by James Van Gielen.
It's quite young, right?
Yeah, 33 years old. Very sharp guy who tends to focus on these huge megatrends. He co-authored this specific piece with Alap Shah, who is the CEO of a tech company called Littlebird.
Okay.
They released this 7,000-word macro memo late Sunday night that basically asked, what if we fast forward to June 2028 and the economy has completely collapsed because AI just became too good?
And then Monday morning rolls around, February 23rd, and the market treats this thought experiment like it's leaked insider information.
Oh, it was a bloodbath.
The Dow was down over 800 points. The S&P 500 fell over 1%, but the sell-off wasn't even across the board. It was like a sniper took out specific sectors named in the report.
Incredibly specific. You look at IBM, it dropped 13% in a single session.
Which is its worst day in 25 years.
Right. Now, to be fair to Citrini, IBM had a perfect storm that day.
Yeah, because Anthropic made that announcement Monday morning, too.
Exactly. Anthropic announced that Claude Code, their AI agent, can now fully modernize COBOL.
Okay, for the listener who maybe isn't a computer systems historian, why does an AI learning COBOL tank a giant like IBM?
Because COBOL is this ancient programming language that still runs the world's financial plumbing. It runs ATMs, the IRS, legacy flight booking system.
And nobody knows how to code in it anymore.
Exactly. IBM makes an absolute fortune maintaining these old mainframes because they have a massive moat. If an AI can instantly translate and modernize that legacy code for pennies, IBM's moat just evaporates overnight.
So you have this fictional report saying AI will destroy legacy tech, and then the actual news cycle says, hey, here's the exact tool that does it.
A brutal 1-2 punch. But it wasn't just old tech that suffered. The gig economy got hammered.
Uber, DoorDash, Salesforce, all down 4 to 6%.
And the payment processors. American Express dropped 7%. Visa and Mastercard down 5%.
See, that seems like an overreaction for a fictional story. Amex is a fortress. Why are investors panic selling American Express over a Substack post?
Because of the scare trade. The market is trading on vibes right now. Neil Wilson from Saxo Capital Markets had a great quote about this.
Oh, the doomsday porn quote.
Yeah, he called it real doomsday porn stuff, which is always lapped up. The vibes to substance ratio on Monday was off the charts. The market exposed a deep-seated fear that this whole AI transition is going to break things before it fixes them.
Well, let's get into how it breaks things.
Yeah.
The Citrini scenario breaks this collapse down into phases. Phase 1 is what they call the death of friction, or the SaaS squeeze.
SaaS meaning software as a service.
Right, which is basically every tech tool we use today.
Think about a modern corporate budget. You pay a monthly subscription for Slack, another for Asana, one for Salesforce, one for Monday.com.
Death by 1,000 monthly fees.
Precisely. And why do companies pay them? Because building your own internal tools is incredibly hard. You can't just hire 20 developers to build a custom project tracker for your mid-sized firm.
Right, it's cheaper to rent the software.
But the Citrini scenario argues that as AI agents like OpenAI's Codex or Anthropic's Claude, as they move from just chatting to actually doing complex tasks, that friction completely disappears.
So I don't need a subscription to Monday.com anymore.
No, you just tell your internal AI agent, hey, build me a bespoke dashboard that tracks these 5 specific metrics for my team.
And it just codes it.
In seconds. For free. If an AI can write bespoke software on demand, the whole rent-seeking model of these SaaS companies collapses.
Total race to the bottom on pricing.
Exactly. The report predicts a SaaS death spiral where companies just ruthlessly slash their software spend because their AI can do 80% of it. The iShares Expanded Tech Software ETF, IGV, hit its lowest level since the Liberation Day tariffs because of this fear.
That makes total sense for enterprise software.
Mm-hmm.
But what about the consumer apps? They went after DoorDash and Uber hard in phase 2. The report talks about the end of habitual loyalty.
This part is fascinating because it challenges how we think about our own daily habits. Think about why you actually use DoorDash.
I mean, because the app is on my home screen and my credit card is already saved.
Right. It's friction. Human laziness is DoorDash's biggest moat. You are too lazy to check 5 different restaurant portals to save $3 on a burrito.
Fair enough.
But AI agents aren't lazy. And they don't have a home screen. They don't have brand loyalty.
So in this 2028 scenario, I'm not opening the DoorDash app at all.
You're not. You're just telling your personal AI, get me pad thai from that place downtown. And your agent instantly scans every restaurant portal, every delivery service, and every vibe-coded app simultaneously to find the absolute lowest fee. It ruthlessly optimizes.
Okay, wait, vibe-coded app. That sounds like weird internet slang, but the report treats it as a serious threat.
It is a serious economic threat. Vibe coding is the idea that coding becomes so frictionless that an individual, maybe just some college kid, can create a functional local delivery app or a rideshare service in a matter of weeks.
Just based on a specific vibe or a local niche?
Right, and if the barrier to entry drops to near zero, you get this massive market fragmentation. You don't just have Uber and Lyft. You have 10,000 micro-competitors destroying the margins of the incumbents.
Wow. Okay, I can see why gig tech investors panicked. But let's pivot to phase 3, the payment revolution. This is the part that hit Visa and Mastercard, and it brings in a huge crypto angle.
The target here is the 2 to 3% interchange fee that Visa and Mastercard charge every time you swipe a card.
Which is a massive tax on the whole global economy.
Huge. And that fee is what funds the whole banking rewards ecosystem, the cash back, the airline miles, the airport lounges.
Right, but the report says AI kills that too.
Through machine-to-machine commerce. In the scenario, if your personal AI agent is negotiating with a restaurant's AI agent to buy that pad thai, why on earth would they route that transaction through a legacy credit card network?
Because machines don't care about consumer protection or airline miles.
Exactly. They care about pure efficiency. The scenario predicts these agents will bypass credit cards entirely and settle transactions near instantly using stablecoins on networks like Solana or Ethereum Layer 2s.
Where the fee isn't 3%, it's a fraction of a cent.
Right, which is an absolute nightmare for card issuers like American Express or Capital One. Their entire business model relies on charging those high merchant fees to fund perks for their wealthy customers.
If the fees vanish, the rewards vanish.
And if the rewards vanish, the wealthy customers leave. The whole flywheel just breaks.
But ironically, this is a massive bull case for crypto. I know Bitcoin dropped below 63K this week along with the rest of the market. But long term, this scenario is literally the AI analysis thesis we've talked about before, bridging TradFi and crypto.
It is. If AI agents default to crypto rails for lower fees, that becomes the biggest adoption driver in the history of digital assets. Suddenly, crypto on-ramps become essential global infrastructure.
Though I guess the counter-argument is that if AI disrupts everything this violently, it crashes all risk assets in the short term, including crypto.
Which is exactly what we saw on Monday.
Right. Okay, let's move to the macro picture. Phase 4, the loop. This is where the report zooms out and looks at the broader economy. And it introduces this term, ghost GDP.
This is the core economic concept of the entire piece. To grasp it, you have to look at who actually drives the U.S. economy.
Consumers.
But specifically, high-income consumers. The report highlights a brutal statistic. The top 10% of earners account for 50% of all U.S. discretionary spending.
Yeah. Okay. Half of all the fun money spent in the U.S. comes from the top 10%.
Then who are those people? They are the coders, the lawyers, the middle managers, the analysts.
The white-collar workers.
Exactly. And these are the exact jobs that AI is best at replacing.
See, the traditional economic view is always that technology destroys some jobs but creates new ones.
The Luddite fallacy, right. But Citrini argues this time is different. Unlike the Industrial Revolution, where machines replaced physical muscle, AI is replacing intelligence.
So there's nowhere to upskill to.
Right. You can't retrain a laid-off software engineer to be an AI manager because the AI is already managing itself better than a human could.
So what happens to all these displaced white-collar workers?
They flood the gig economy, which suppresses wages there, but more importantly, they stop spending. That top 10% stops buying houses, they stop taking vacations, they stop buying consumer goods.
Which triggers what the report calls a feedback loop with no break.
Step 1, AI gets better. Step 2, companies lay off staff to boost their margins. Step 3, those displaced workers stop spending.
And then corporate revenues drop because aggregate demand just fell off a cliff.
Exactly. And what do corporations do when revenues drop?
They invest even more in AI to cut costs further.
And the cycle repeats until you reach ghost GDP.
Okay, define ghost GDP for us, because it sounds super dystopian.
It's an economy where output looks incredibly high on paper. The machines are producing millions of lines of code, endless content, perfectly optimized supply chains. So productivity is through the roof.
But the velocity of money flatlines.
Because machines don't buy things. A server rack doesn't go to Disney World. An AI agent doesn't take out a mortgage on a house in the suburbs.
So you have all this production and no human consumption, which leads directly to phase 5, financial contagion.
Right. The real-world consequences.
The report specifically maps out a private credit crisis.
Think about all the private loans made to software companies over the last 5 years based on the idea of recurring revenue. If AI agents destroy the SaaS model, that revenue is gone. The company's default.
And then there's the mortgage crisis.
The prime mortgages. Loans made to tech workers in Austin, San Francisco, Seattle. These are supposed to be the safest loans in a bank's portfolio.
But if those workers are permanently displaced, they default too.
The scenario ends with a prediction that by June 2028, unemployment hits 10.2%, the S&P 500 crashes 38% from its October 2026 highs, and you literally have Occupy Silicon Valley camps set up outside OpenAI and Anthropic.
Okay, we need to take a collective breath here, because this is terrifying stuff. But we have to look at this objectively. Is this real, or is this just extremely effective fear porn?
That is the big debate right now. The doomer versus the optimist. And we have to acknowledge, even Citrini explicitly labeled this a tail risk.
Right, it's a possibility, not their base case prediction.
But the market reaction proves the fear is very real. And it didn't help that Michael Burry, the guy who called the 2008 housing crash in The Big Short, quote tweeted the report.
Oh man, what did he say?
He just wrote, "And you think I'm bearish."
Wow. Yeah, when Michael Burry amplifies a crash scenario, people hit the sell button.
It poured gasoline on the fire. But, Alap Shah, the co-author, went on Bloomberg to defend the piece.
Did he walk it back at all?
A little. He admitted the market reaction was bigger than they anticipated. But he stood by the core thesis. He pointed out that the U.S. actually hasn't created net new white-collar jobs in 3 years.
Really? In 3 years?
Job displacement is happening right now, not in 2028. We are already seeing AI coding agents and AI customer service taking human roles.
So the question isn't if AI disrupts jobs, it's how fast and how deep.
Exactly. The real risk is the speed. Previous technological transitions, like agriculture to industry, took decades. Generations could adapt. AI might do it in 3 to 5 years.
But there is a counter-argument to all this doom, right? The reinstatement effect.
Yes. Economists argue that technology always creates new tasks that we simply can't imagine yet. 10 years ago, nobody was a prompt engineer or a social media manager.
So maybe we find new ways to create value. Also, the Citrini scenario assumes the government does absolutely nothing while unemployment goes to 10%.
Which is highly unlikely. If we saw mass white-collar unemployment, you'd see massive policy responses. Universal basic income, AI taxes, maybe compute royalties where citizens get a dividend from AI productivity.
And we also have to talk about physical reality, the atoms versus bits argument.
This is a crucial point. AI is incredible at manipulating bits. It can write a legal brief or code an app in seconds.
But it can't fix a leaky pipe.
It can't build a house. It can't upgrade the electrical grid. It can't construct a data center.
So physical jobs, the trades, infrastructure, those might see a massive boom, even if the software sector crashes.
Right. And smart money is already positioning for this. Look at the hedge funds. They pulled $3.8 billion from Bitcoin ETFs in just 5 weeks recently.
Because of the same underlying fear of a liquidity crunch.
Yes. But if you look at what held up during Monday's crash, the strategy is becoming clear.
Which brings us to segment 5.
Yeah.
What do we actually do about this? Let's start with investors. If I'm managing a portfolio, what's the takeaway?
The takeaway is that fear is already being priced in. You don't panic sell your whole portfolio based on a blog post, but you do pay attention to the shift.
The shift from bits to atoms.
Exactly. Focus on the physical world. Energy, data centers, commodities, and watch the pick and shovel plays.
Like NVIDIA.
NVIDIA, TSMC. They held up much better than the software companies on Monday because no matter what AI agents do, they require massive amounts of physical compute and electricity to do it.
What about for businesses?
If your entire business model is being a middleman, extracting a toll for reducing friction, AI is coming for you. You have to adapt or die.
And for the individual worker, for someone listening to this on their commute to a middle management job.
It's a wake-up call. The intelligence premium is unwinding.
Meaning being smart isn't enough anymore.
Right. For decades, processing information was the scarce asset. Now AI does that instantly. You need to shift your focus to skills that require human intervention. Empathy, physical presence, high-stakes accountability.
Things a machine can't take the blame for.
Exactly. You have to learn to work with the AI, not compete against it.
This right here is exactly why we do these deep dives. The headline on Monday was just market crashes, but the actual story is about a fundamental shift in how value is created and who gets paid for it.
It's a paradigm shift.
A 33-year-old's blog post moved billions of dollars in a single day.
Yeah.
That is not just about one analyst's opinion. That is about a market that is terrified of what is coming.
The anxiety is real.
Whether the 2028 scenario plays out exactly as written or not, the fact that Wall Street took it this seriously tells you everything. The AI revolution isn't theoretical anymore. It is being priced in.
And it's moving fast.
I want to leave you with one final provocative thought from the report. They mentioned a concept called agent-on-agent violence.
That is such a wild term.
It's the idea of machines constantly negotiating with other machines to drive prices down to absolute zero. If your job is being a middleman and the machines can just talk to each other directly, who are you even negotiating with?
It really makes you question where humans fit into a frictionless economy.
Something to mull over. Subscribe to AIA Uncut. We'll keep breaking this down.